You'll often hear me say that stocks historically have been the best protector against inflation because prices going up is what we have when we have inflation. Companies are the entities raising prices, and you own the entities raising prices when you own stocks. Now, you'll hear other things like gold, and that historically has been a terrible protector against inflation. Matter of fact, the worst period of inflation in this country's history, on this chart behind me, is in the early 1980s. And if you look at what happened to gold during the early 1980s, it actually dropped in value significantly. So it's been a terrible hedge against inflation. Well, how do we protect ourselves against stock market declines? Because nobody likes to see their investment portfolio drop in value. So people will look for information to tell them that the stock market's overvalued. Articles like this, bear market is required as stocks overvalued. This one right here, even the most generous valuation gauges show the U.S. stock market is overvalued. And then this one right here, stock market is overvalued and overpriced. What should investors do? So we look for information from people that seem to be very educated and very informed as to what we ought to do with our portfolios. There are a lot of different areas of the stock market, as you've heard me say. You got large companies, but you also have small, and most Americans, they're enamored with large companies. Big mutual fund companies, that's where they concentrate most of people's money, and investment firms as well. But you should also look at small companies and value companies and international small value and large value and emerging markets. There are a lot of different segments of the market. So what I thought I would do is I would take the different companies and different types of companies that we would own in a portfolio and say, okay, well, what are they priced right now compared to history? Compared to assets minus liabilities. So compared to the assets of the companies. That's how we determine value. And if you look at recent history, and that's what this chart is doing, all the way back to where I had all of the data that I could get access to for all the asset categories back to 2007, I figured that was a good enough period of time just to show what's going on. If you look at large and small and large value and you add them up for each year, what is the price compared to book value this year with large plus small plus large value, plus small value, plus international large value, so on and so forth, all the different asset categories, add them all together and look at them year by year. So right now, what are they all added together? What were they last year, the year before that, year before that? And what you notice is something really interesting. The very, very bottom bar in this chart is recent. The next one up is 2007. You see that's fairly high. Remember the market dropping down in 2008. Well, prices were a bit higher at that particular point in time, as you can see right here. But there were a lot of really good things going on, so it wasn't something that we would know except in hindsight that it was going to come down in value. And then you look at 2008, 2009, and you look at all the different years, and what you notice, which is interesting, is that right now is right in line with history when you look at it. Now, the second thing we can look at here is look at all the different asset categories with a different view on the chart. And what I want you to notice is that there is one line that doesn't seem to be fitting with the rest of them. Can you tell which one it is? Well, obviously it is the very top line. And what is that top line? That is large U.S. companies as measured by the S&P 500 compared to everything else. Now, since American investors tend to be totally focused on big U.S. companies, it should come as no surprise that when you hear people say the market's overvalued, that they're talking about that one area of the market. Now, is it overvalued? Well, we don't know that. We can't know that. Why? Because you have to know the future. You have to be able to predict when. It's like Alan Greenspan in 1996 saying that investors were irrationally exuberant. So he was basically saying the market's overvalued. Well, the market didn't actually drop for another 4 years, so you missed out on a lot of returns if you had basically listened to what he was saying at that point in time. Now, so number one, only a small portion of our portfolio would be in that one area of the market. So I wouldn't sit there and go, oh, gee, it's time to get out of the market, because other areas are sitting right in historic norms, no problems. Number one, first takeaway. Second takeaway is that if you look at all of these articles that talk about the market being overvalued, I literally grabbed the most recent ones I could find. They were 3 weeks old before the market actually went up. So it just shows you that no matter how you trying to figure out where the market's going next, when it's overvalued, when it's undervalued, It's a big waste of time, but the media likes to try anyway. We'll catch you next time.